I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview. Hey everybody, Nate Lind here. We've got an advanced finance section coming up for you. I've got Tyler Jeffcoat from Seller Accountant. We're going to go through some P&Ls, some balance sheets. We're going to go through some do's, some don'ts, all that sort of fun stuff. But before we do that, Tyler, tell us a little bit about your background. How did you get here? And then we'll jump in.
Yeah, Nate, thanks for having me. I'm an accountant that was entrepreneurially lost pretty early on, had the privilege of joining a healthcare startup and had a good run, 0 to 100 employees in 4 years. And I exited that brand and really fell kind of back into the e-commerce space. I've been kind of a scrappy eBay guy during college. And, I love what you do, Nate, because my MBA focus is really the merger side. So this idea of how do you develop enterprise value? And because I'm an accountant, I view it through the lens of a CFO, right? And so Seller Accountant is a specialized bookkeeping and kind of fractional CFO shop. We only service e-commerce brands. And so we're pretty good at it because that's all we do.
That's awesome. That's a huge need. The first thing that we go through when talking with the seller about potentially listing their business is their financials. The financials, kind of the way to think about it is if you're selling things online, if you're selling on Amazon, think of your financials as your product photos, your product description, your price. Everything that your potential client or customer is going to see. The buyers start with your financials and end with your financials before that money hits the escrow account and then hits your bank. So it's probably one of the most frustrating aspects of it. I know as an entrepreneur, I hate doing my own financials. I hire folks like yourself. I had a great CFO for a number of years that she handled all that for me. And it's one of those things that's the first thing I delegate in my business. And it's the last thing I take back if I've got to wind down or something. So that's been my perspective. Tyler, what do your clients think when you get involved?
No, it's much the same. I mean, everything you said there, Nate, completely resonates. I love that analogy with your listing. I mean, anything we can do as a seller to lower the buyer's anxiety, those barriers to pulling the trigger, obviously that's going to help us move our top selling SKU on Amazon or another sales channel. But in the transaction world, it's exactly the same. And I couldn't have said it better than you just said it. They're going to peek at the financials and it's almost like looking at your photo. You're going to be building trust for your brand right away, or you're going to be eroding trust based on how believable, understandable, clean, there's a BS radar that can go off really quickly for an investor if things are messy. And so it is really important, in a good year, it's really important to have great financials. In a hard market, we're kind of in the middle of a wonky market right now. It's even more important to understand your financials. And if you want to go to market, it's critical. And I would say that the attitudes of our clients is very similar to what you just said, right? It's the thing that you didn't get into business because you're an accountant, right? I mean, this is full transparency. This is my second entrepreneurial venture. And it's a freaking bookkeeping company. We didn't keep our own books that well for the first 6 months. And it's because your first most important job as an entrepreneur is to find a way to make money. You got to find a way to build a profitable business model. And then you're going to go back and try to invest in making your financials and your systems and your processes reflect the validity of your business model. And so I think our customers are normally getting to a point, kind of like yours, Nate, where they really need to up their game from the financial standpoint so that they can take that next step, whether it's to exit or scale or sit on the beach, whatever their goal is.
That's exactly right. So, and you couldn't have said it better. You hit the nail on the head. The entrepreneur's first goal, make money. Second goal, make money. Third goal, make money. But when you're looking to maybe sell your business, first thing, financials. Second thing, financials. Third thing, your damn financials.
Right.
There's not much you can do. People get frustrated with this. It's like, wow, why does it need to be this way? Well, this is the one way that a potential suitor can look at. They can see all the information they need to about your business, whether it's an income deal or an asset deal, whatever it is. They need to see something and this is what they're looking for. That begins the conversation that opens the door to strategic partnerships, the full sale, a partial sale, and everything in between. So Tyler, you've got some examples you're going to share with us that we can go through, right? So we can show what are some typical examples of some nice looking financials for people to model their own after.
I sure do. Yeah. So this is just pretty basic. I want to walk you through an example of a really nice balance sheet. This is the BS. Most entrepreneurs hate BS, right? Well, they also hate balance sheets. And so walk you through what a typical strong balance sheet looks like. I'm going to show you what a typical really sucky, really weak balance sheet looks like. And then we can kind of pivot and talk about profitability and P&L. So, the American accounting system, like the numbers actually do mean something. Your assets are always kind of your 1,000 numbers. Your balance sheet's going to have a picture of your cash position, anything that's receivable. For a seller, somebody that has a product brand, which will be a lot of our customers, Nate, this inventory line is important for two reasons. One is it's an asset that needs to be brought onto your balance sheet. But secondly, it's a non-liquid asset until you can sell it. And so understanding your liquidity, which if you can see, if you're watching this video, the red letters on here are kind of how you measure your liquidity, which is your ratio called the quick ratio. And so I want to try to understand what my assets are minus inventory, because inventory doesn't get converted into cash until I figure out how to freaking sell it, right? So I want to take that asset understanding. In the example that I have on the screen here, they have about 100K in total assets, minus 80,000 of that is actually inventory. It leaves them with $20,000 in liquidity. Now, this is actually the example of a poor balance sheet, because you look down here at the liability section. This is your 2,000 area of your balance sheet. You got some payables. You've got maybe some sales tax liability. You might have some notes payable. But for this particular seller, their quick ratio, which is that $20,000 of liquid asset, that's the cash, that's the stuff they have in the bank, plus whatever Amazon's going to pay them next week, divided by their current liabilities. In this case, it's 46 grand. They only have 43 cents available right now in the bank to pay for every dollar they owe in debt. So a quick ratio of anything less than one, in this case right here, a quick ratio of 0.43, means that this seller is really stressed out because they're praying for the next paycheck they need PayPal to come through. They need Amazon to pay them. They need something else to come through, or they're not going to be able to meet their obligations in the next couple of months. And so this is a picture of a seller who probably lost sleep last night because of cash flow issues, because of stress related to their liquidity. Let me find this other one here. Here it is. All right, here's an example of a much better capitalized business. One of the biggest things we see, Nate, with our sellers is they don't have enough capital in the business. They're having to lean too much on bad debt that's expensive because they don't have cash. This is that same balance sheet. Cash going to be up here in the kind of 1,000 area. They've got a small receivable from Amazon. And then this particular seller has just short of $45,000, $50,000 in inventory. No big deal. We're going to take their asset value, subtract those two inventory numbers. And this guy has liquidity on the amount of about $82,000, which in and of itself doesn't mean anything. But when you compare it to his current liabilities, now this quick ratio is 2.6. That means they have $2.50 in the bank for every dollar they owe in current liability. As just a CFO here, I'm like, wow, this is a much healthier business. This guy didn't lose any sleep last night, Nate, because of cash flow. Does that make sense? Does the balance sheet stuff kind of make sense here? Any questions about that, Nate?
Yeah, it's amazing to look at it from your perspective. I like how you've broken it out this way. I'm ashamed to say that I've done a lot of e-commerce sales and not even known that simple of a way of looking at things. Man, I'm a little embarrassed, but I'm sure if I am, that means probably 98% of the people watching this are too.
Well, this is what I like about the quick ratio is it's a very simple, liquid assets divided by my kind of current liabilities. And I'm going to be able to put a number on how stressed out I'm feeling right now about cash flow. That's what I like about it. And what it basically would point to, at least if you tracked it over time, is if your liquidity is going down, which means I am less able to meet my obligations, then I want to be proactive so that I can try to seek a better loan. Maybe I can get my financials in order and go for an SBA loan, or maybe I can try to raise a round A or get some investors involved before I'm in trouble, before I'm about to fall over the ledge of bankruptcy, right? I think that's the reason we talk about this. And you don't have to feel crazy. If you have a cash crunch, that probably means you don't have enough liquidity in your business. You need to find some cash. The thing I would caution you on is there are so many lending vehicles out there now, and they all have their place. None of them are bad, but if you have a fairly low margin portfolio of products and you have a relatively high interest rate debt vehicle, that's a recipe for disaster, Nate, right? So if your margins are fairly low, maybe you're a reseller, or maybe you just have kind of a more commoditized product, and you couple that with high interest rate, you're going to have some issues. And so I just want to caution sellers, the more proactive you are, the better your package is, which is what Nate's investors need anyway, the easier it's going to be for you to raise the cash you need, whether that's through an exit or whether that is, because you know this, Nate, but not all exits are full exits, right? You might want to find a strategic partner that lets you roll up equity. Well, having a clean balance sheet, it makes it a lot easier to do that.
Yeah, and in the bigger deals too, the over $10 million private equity, companies that are looking for brands and e-commerce businesses and agencies, they want the seller to stay on. They want to keep them around. So they keep some equity and keep on trucking, and then get another exit later on. That we see that's very, very common. A lot of private equity and over $10 million deals are that way.
Yeah, it's been my experience also. As soon as you have 7-figure EBITDA or 8-figure valuation, the investor is going to want to be convinced that you haven't set them a bomb that's going to go off when you leave. And so that just makes complete sense to me.
Yeah.
You ready to walk through kind of a simple P&L?
Let's do it.
So I would call this a baseline, simple profit and loss statement for a single channel seller. So this particular seller only sells on Amazon. A couple of things I want to bring to your attention, and then I'll show you a more complex example, is your accounting system is going to give you the ability to use a numbering matrix. And you might ask yourself, well, why the heck would I want to do that? Well, the reason is that numbers allow you to override the natural alphabetizing that Xero or QuickBooks Online or NetSuite or whatever you might use for your accounting. Those softwares don't know what's more important to you or less important, so it's just going to alphabetize it. But as an investor, and again, Nate, I know you and I both view ourselves as investors first. Like, I want to understand enterprise value. The cleanest way to present my profitability is to have a clear picture of gross sales. The seller did about $31,000 in December in gross sales. Then what's the clear picture of the impact of, from an accounting standpoint, they would call this like contra accounts. You've got promotional discounts, you've got some refunds. FBA might find some inventory they lost and give you a reimbursement. And then I want to be able to understand the net sales. So how did my Amazon.com, for this seller, for instance, how did that sales channel perform in a given month? The second thing I want to mention from this example is that you got to have your books and your financials stated in an accrual fashion. That means I'm actually capturing the sales and the cost of goods sold in the month they happened as much as we practically can, instead of just expensing the inventory when I purchased it 3 months ago and just capturing the revenue when Amazon makes a 14-day deposit. You don't want your revenue and your expenses to be all over the place. And this example on the screen here kind of shows you why.
I want to pipe in real quick here too.
Yeah, go ahead. So
we see this all the time. Accrual-based businesses sell for more than cash-based businesses. And if you've got a business that's holding inventory, it's damn near impossible to sell it unless it's on accrual, because that's just the industry standard.
So thank you for saying that. I mean, it's a validation of our model, but at the same time, it just makes sense. Like, an investor can't understand the most basic question. Tyler, did you make money last month? You can't answer that most basic question unless you try with some integrity and with a system to line up the expenses with the revenue. And here's the reason you want to do this, even if you aren't going to sell, even just as a CEO that wants to make money. Let's compare December and January on this random P&L here. I want you to notice that the net sales amount was about equal. It's $400 more in December than it was in January, but it's essentially the same sales. But when I look down at my gross profit, I made over $1,000 more gross profit in December than I did in January. here's why this is important. This may not seem like that big a deal. If I have tight accrual accounting, this is going to make me pause and ask some really important questions, Nate. Why the hell did I make an extra $1,000 selling the exact same amount of goods one month over another? And it's going to give me some insights and visibility into why my business is performing. Not just whether it's performing, but why it's performing. And the second thing down here, notice the second kind of line of the expense section is the advertising. Not only did December make $1,000 more in gross profit, but once we factor in the advertising budget, it actually made $2,000 additional dollars in profit. And so there's some important, kind of think about it like you're flying a plane. Your financials need to give you the visibility where there's some dashboard dials that are saying, hey, advertising's out of whack. Hey, fulfillment's out of whack. Hey, refunds is a problem. We need to do a quality assurance check with our supply chain. And that's another reason you just need to have really simply stated financials. Let me show you a more complex example really quick. Before I do that though, Nate, do you have any questions about that or anything?
So something we see, usually what happens when a seller comes to us is we have to take these financials and put them into an SDE worksheet, so seller discretionary earnings. So things that make the broker's life a little easier. And then it also translates into making the buyer's life, much better too, is breaking out the cost of sales. So like Amazon advertising, if it's if you're running Facebook ads, you've got that broken out, or Google. And I like to see that in kind of like that first thing underneath cost of goods. So from a numbering perspective, if I had it my way, I don't know if this is industry standard or not, I'd love to see that as like the first thing with then subcategories underneath of it with the different marketing channels. So it's all put together. Because oftentimes what happens is the seller's sending me their financials and they call it all sorts of stuff. It's advertising, it's acquisition, it's retail, it's you name it. And I've got to find all of that and set that aside, because it's usually the largest or second largest expense in an e-commerce business. And that's a number that they want to see for sure. So, oh yeah, I see it right here.
Yeah, it's really good. I mean, honestly, just from a industry standard, for whatever reason, accounting, because it's an AC, sometimes pops up first. But I'm with you. I would rather have this down in legal and professional and then have a very clean 6100. And I want to understand advertising by sales channel. Like, what is my strategy related to Facebook? I want to get those ads. What's my strategy related to Amazon? And this is kind of the delicate balance that you have to walk is, I want my P&L to be as simple as it can possibly be, but give me every bit of data that makes it it's almost like the bullet points on a listing again. I don't want 35 bullet points if I can tell the product story in 5 bullet points, but I need every bullet point necessary to tell a clear story. How do these numbers happen?
This level of detail is important because sophisticated buyers want to know how much are you spending on Amazon, how much are you spending on Facebook, how much are you spending on Google, and then they want to know the percentages, which you've got right here. These are the questions you're pre-answering all of the questions that a sophisticated buyer, and then you're checking the box of sophistication and professionalism in their mind. Like, oh, these guys track this. That's what a professional seller that's going to sell in the 7 figures, definitely 8 figures and more range is going to get. Even in the 6 figures, if you're selling we're going to list you at 500,000, pretty much our minimum, on up. You got to have this because it's going to come up in due diligence. We may as well just skip over that question.
I agree. I pulled up a slightly larger P&L here, and the one thing I want to add to it is, you do want to separate your sales channels. So, Nate was talking about having the advertising split. I also really want to understand how Amazon performs over time versus Shopify versus eBay. If you have a wholesale network where you're selling to retailers that are bricks and mortar, the quality of those earnings can be different. And I want to understand, like a great example of it, Nate, might be that you may be able to show total sales that are still up year over year, but a major sales channel broke 6 months ago. Like you're not selling to a major brick and mortar shop anymore. Well, as an investor, I need to know that. I need to understand that context and that color, or I'm not going to be able to make a valid offer on your business. I don't know anything else you want to add to that, but I think that's basically a quick walkthrough of the P&L.
Yeah, I like that part too. I mean, I think maybe one deeper level sophistication could then be how the advertising is tracked to those different sales channels. But that now we're starting to get into complexity land,
Mhm.
303. We're starting to get there. But as the more, it's sooner or later that's going to come up. If you're advertising on Facebook, some of your Facebook advertising could be amplifying your Amazon sales, or maybe your Shopify. So being able, so a sophisticated direct to consumer merchant or retailer, seller here in this instance, should be able to track what's going through paid marketing from one source, Facebook, to a destination. Now that doesn't necessarily mean that you can track the organic effect of those paid ads, because sending a bunch of paid media from Facebook to Shopify will translate into organic sales in Amazon, and there is a direct correlation that's fairly untrackable. Someone knows how to track that, by all means tell me, because I haven't seen it yet. But having some of that detail could be critical at the larger level too.
I agree. I totally agree. And even if something like that, like understanding Facebook efficacy with relation to a Shopify versus Amazon, that can be a difficult data point to capture even in a good accounting system like this. But what you're mentioning there, Nate, is understanding your customer. Your customer is a future investor in your business. Understanding their frequently asked questions and putting together a packet that alleviates that question by answering it right away. There's no excuse for sellers that are doing seven figures, even a high six-figure seller, to not use pixels and to not use Google Analytics and to not have a way to at least tell a coherent story. Because even though you may not be selling a product that let me just say this, every product has a funnel, and your ability to articulate to an investor how well your funnel operates. I put a token in, my machine works, and it spits out X number of sales. Your ability to articulate that in a clean manner is going to be supported by your accounting, but you're probably going to need to have some other dashboards and some other data points that help you tell the story, because that's really an important piece of this. And I agree with what you said earlier, Nate. The reality is, American accounting tends to you have to put the advertising down below gross profit. But frankly, if it were up to me, I would throw gross profit out altogether. Post advertising gross profit, we call it PAG. PAG is the most important number on your P&L. Understanding what your GP is. You look at this customer. This customer has a 55 or 54% GP, but that's meaningless. It absolutely means nothing until I understand what the fuel was, the advertising juice they're having to put into this brand in order to get it to move. And the difference in those two numbers, the 54 minus the 18, gives you kind of your top line bound on what the value, because obviously SDE is going to come after you pull everything else out. But how do you feel about that? I mean, don't you wish that with the GAAP accounting would just let us put ads up here in COGS? I mean, make it so much simpler, right?
I totally agree. I've actually had a pet project where I was creating kind of a standardized e-commerce chart of accounts, and I put cost of sales like up there, not really knowing what I was doing, but it's a lot of times it's more than your cost of goods. That the cost of sales, when it's more than your cost of goods, it just seemed funky for me that it's just a line item under expenses, like it needs a whole breakout.
I mean, look at this example here. The actual product cost that this seller sold over the course of 12 months, 18%. Total advertising, 18 and a quarter. So, I mean, yeah, it is really important. I do think it's okay keeping it with the American kind of standard, but I do like what you said, Nate, having it as close to the top as possible. Having it as, I like having the sub accounts here where you can really cleanly understand total ad spend and then breaking it down by channel.
Mm-hmm.
Yeah, it's good.
Cool. Let's keep trucking.
Well, that was the main stuff I had to share with you from a financial standpoint. I was just going to say, your ability to invest in things like R&D, your ability to invest in future product launches is completely dependent on that post-advertising gross profit number that I mentioned to you, that GP. Let's just say for simple numbers that your gross profit's 50 and you're spending 15% on ads. That 35% post-advertising gross is a good number. By the way, I just want to say that 35% after ads will be an outstanding number. Just to give you an idea across the board, I wish I had my study up here. I would show it to you. But we did an aggregate study of about 120 million in total e-commerce sales for 2019. we saw that post-advertising gross profit number at about 25% across the board, maybe a little less, like 24.5%. What that means is I've bought the product, I've got my fulfillment, I've got my Amazon or merchant fees, and I've included advertising, and I'm left with about 24 points. We found that to be a benchmark for fairly successful portfolio. Our top 10% sellers are closer to 30 points after advertising. And anything south of 15, we recommend killing those products. I'm not even talking about a portfolio here. Now you just look at individual SKU. If I can't sell a product and after advertising consistently keep 15 points, now if I'm Walmart, I can do that. Walmart's not keeping 15 points after ads. But if you don't have tremendous scale and you're trying to, especially if you're trying to be a private label brand or trying to build a brand, I need to have a path for my investor that shows them at least 15 points after advertising, or that I might not be investing my cash in the right products. 20, 25, I'm really happy with. 30 is outstanding. I mean, what have you seen? I just want to hear what you're seeing in the market there, Nate. What are you seeing in that area?
Yeah, those are some pretty good numbers. 30%, 30 points is kind of like that target, and it's hard to get to. It's only certain groups can get there, and it takes a while to get to it. One thing I was going to ask too, I've seen some financials from individuals that have sold before, and they understand the whole concept of seller discretionary earnings and add backs, and they've gotten as sophisticated as to start to move those line items into kind of that chart of accounts further down. So they're really easy to identify. So stuff like discretionary travel, automotive, meals, entertainment, like that kind of stuff. Do any of your clients, or have you guys messed around with doing something like that, which that really breaks down the level of ease to find that a lender's going to look at and a buyer's going to look at, and they can see, okay, this, and to quickly recap for people, that would be an expense that a buyer may not necessarily be taking over. Like those are usually done for tax purposes, to get the taxable income down as much as possible. So like I said, automotive, like if you got a car payment on there, the new buyer's not going to have a car, they may not have a car payment, or if they do, that's their own expense. So key man insurance, like stuff like that, are things that come up there quite frequently.
I love that. I mean, I think what you're articulating again is there's this dance of kind of arguing what is valid, what's discretionary, what's non-discretionary. And the answer is no to everything you don't ask for. And one of the cleanest ways to ask for it is to take a section kind of down where you would normally put payroll, kind of near the bottom of your P&L, and kind of make a discretionary spending account and add your owner salary. A lot of times a portion of your owner salary will go there. That's kind of the biggest one normally.
Yep.
You're going to conferences. Maybe you just choose to go to the Prosper Show or ASD. The travel, like you said, anything that because a smart entrepreneur is going to run some expenses legally through his business or her business that lowers tax liability. And a smart investor isn't going to punish you for that as long as you can demonstrate that the value of this asset you're selling me, the validity of the cash flow you're selling me isn't going to be diminished if I add this back for you. That's really the argument. And so I'm a proponent of, I would say, keep your P&L simple. So phase one is keep it simple. When you get maybe within 12 months of looking to sell, I would almost say, let's go ahead and start determining which of our line items might be discretionary. Let's talk to somebody like Nate and get an expert opinion on what the market is currently tolerating as an add back. And then as you get closer to actually putting your packet together, to be honest with you, with a professional accounting team like mine, taking 5 or 6 line items and moving the chart of accounts to make them a bundle, that's a 5-minute task. Like that's nothing you need to pay an expert to do. The big picture is, Nate, what's the market going to bear? Have we been smart enough to put those things in separate buckets now for the last year? And can we then turn around and just, before we print the packet, let's move them into a bucket down at the bottom that kind of separates it? And I think that's a great best practice. Probably not the first best practice, but I think it's one before you go to market that, again, it's always no unless you ask for it. I would put everything down there that you think is discretionary and make the investor argue with it. I mean,
Yep. We've had a number of requests, just personally to me and in other comments and stuff for a request for more information about kind of like what does, kind of like a boot camp for sellers to prep for sale. And a large component of that is getting their financials in order, identifying their ad backs, getting, the financials all whipped into shape and that sort of thing. So,
and one more thing about ad backs, I think whatever Nate and the pros in the industry are seeing as an acceptable ad back, go ahead and start separating that as early as you can so it's in a separate GL account or a separate chart of accounts account. And then anything that you would view as gray, like when you talk to Nate, he says, I'm not sure. I'm cutting it. I'm cutting it unless it's making me money today and making me money tomorrow, because I don't want to have to fight any more of those gray battles than I have to with an investor. And that's another thing. You're talking about kind of this boot camp for 12 months to launch. That may be another best practice to toss in there is whatever's discretionary that's clearly discretionary, cool, let's put it aside. But if it's maybe kind of sort of discretionary, I'm going to pick which of the three. I'm using 5 different SaaS dashboards to manage the same profitability metric. And I'm knowing that the future buyer is going to have to pay something for a dashboard. I'm going to pick one and cut the other 2 because I want to be intelligent with those kind of expenses. Is that kind of what you're saying also?
Yeah, absolutely. I talked about this a little bit with Roland Frazier. Any dollar you can cut, it's going to turn into an exponential return for you when you sell. So it's critical. In fact, I was sitting at one of his intensives, one of his boot camps while they were prepping to sell Traffic Conversion Summit, and he and Deanna were going through their books, and they were looking at, okay, what are we, and they had some time. Like, sometimes these sales can take 3-4 months, especially the big ones, like when you're 8 figures and more, which is what he went through. You've got some time to work through this, and so you can clean and cut and create efficiencies.
I just want to echo what you said early on. As a guy like you who's built, I had the privilege of being a part of a 120-man team and had a chance to exit that business. I know you've exited some larger businesses also. Don't wait too long to get this stuff in order. The stuff we just talked about, the financial basics, and then kind of getting more sophisticated. Don't wait for anything. Let me just say, being proactive. Don't wait until you're out of cash to decide you need to raise cash. Don't wait until you have to sell and your partnership's falling apart with your old buddy before you decide to get your affairs in order to sell. Don't wait to have that hard conversation if you've got an issue with a partner or a supplier or something like that. Don't put it off. And I think if you kind of have that mindset, I'm going to constantly, and then this thing I'm sure you tell your customers all the time, is you've got to sell this thing while you still have some fuel in the tank. What I mean is emotional fuel, because the deals do take several months. And I will say that some of my clients that have had the most, you call them like traumatic exits. A traumatic exit is one where you're on the cusp of death and you need a 6-month or 3-month timeline to get all the way through due diligence, get SBA funding and everything else. And you start letting things slip through the cracks, and it ultimately harms your valuation before you get to the end because you didn't have enough fuel left to get it done. Don't wait that long. Place the investments early so that you can build a business that you love. And I think if you do that, you're going to be great.
Tyler, thanks for sharing all of the magic that you did. Looking forward to talking with you more. After this as well, we've got all sorts of cool stuff coming. So if those of you that are watching, stay tuned. Everyone say thanks to Tyler. Tyler, thanks.
Take care, guys.
Thanks for watching. If you liked this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious to how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.